Well, and if we set a new trend, which the oil market's desperate for, right? I mean, there's nothing worse than no trend in an oil market as a trader. So the market wants a trend. So it's looking more and more likely, isn't it, ultimately? Hi again, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, joined today with Meta this time, and James and Vincent. Just before we start, just wanted to highlight a new show, The Officials, which had its first episode on the weekend, done very well. You may have seen Jorge Mentepeke, who runs the show, his reports online, on LinkedIn, on onyxhub.co. He's now doing a video-based series similar to this podcast, so please be sure to check that out. And as always, please remember to like and subscribe to our channel. It really helps. So, right, Meta, could you start us off with a summary of flat price, please?
Yes, will do. So all of last week, the September Brent Futures was comfortably trading around 85. Like we saw resistance a little over it, support a little under it. It just seemed like a comfortable place for it to trade until Friday, where it sold off to below $83 per barrel. And we've seen a downtrend from here. It's currently around 82.50. It was below that just an hour ago. So it has been, there is a definite bearish turn to where the range boundedness that we were in last week. So when we look at CTA positioning, so our own model for this positioning shows a decline from 4.6 million barrels in position on 19th July to negative 2.5 million barrels on the 22nd, that is the beginning of this week. It's currently further into negative handles right now. The same for WTI, which has seen more bullish interest. If you look at CFTC data, even then with CTA positioning, it's gone from it has been declining, and it's also in the it's just entered negative handles in CTA positioning as well. So just to touch over CFTC data as well for the week ending 16 July, broad marks were really risk off in Brent, and even money managers, they increased length by just 500 lots this week, while shorts rose by over 18 million barrels. The long short ratio declined to under 3-1, which is in the 20th percentile for weeks over the past decade. WTI saw more risk on by physical players. There were more risk on. They were increasing their longs and shorts, and money managers were also more bullish, which could be an indication of how Cushing inventories have been declining, and just the weaker freight, which has opened the physical arbitrage between the Atlantic basin and Asia. So, and that said, WTI also sold off pretty aggressively on the 19th of July from $81 to $78 per barrel. So we've also seen outflows from selected oil ETFs. The USO saw open interest for call options decline by 23.3% week on week. Put options also came off by 40.5% in open interest week on week. And SEO has also seen open interest decline. So it's not just like a bearish, bullish thing. It's just everyone's in just that particular, like ETFs wise, everyone's just de-risking.
Yeah, there's a few things going on there. So one, let's address if we want to talk about this move, which is significant, holding around 85 and then suddenly, in almost like in a sneaky way, it suddenly sells off to below 82. You're talking like, when you wake up in the morning, when did that move happen? Especially on a Sunday night or a Monday morning, you're like, I swear it was 85 all week, what happened? So these moves can happen quite aggressively at moments when you're not looking. And I think that is kind of the whole point. So I would probably start by saying if it was a Friday night, not even Friday afternoon sell-off, you're getting towards the end of the week, and it's probably a good time to liquidate any longs or possibly even get short when you don't really want the market to be aware of it, or doing it at a time where for some reason or another you want it to be out of hours. So something there that's relatively interesting, and bear in mind that the Friday CFTC stuff is all about Tuesday, right? So we're not going to get that date until Friday, but I assume the ETF information is up to date. In other words, it is from Friday's reactions. Yeah. So on Friday, we had like essentially de-risking from speculators and investors using ETFs. So you could argue that that's exactly what it was, right? A lot of the way the ETFs work is you put in your order and they wait until the end of the day to execute it. So it could have just been, a pretty decent liquidation for whatever reason, maybe wanting to avoid the weekend, or I don't know, but there could have been a lot of movements on Friday, maybe some macro data, and ultimately those orders got executed all at once on Friday. So it's probably quite significant event because it's showing you what will probably transpire is the CFTC next week will show that actually this length that we've been seeing in managed money is probably reversed or at least reduced. And interesting to see that it's still risk on producer merchants in WTI. But again, that is sensible because on a relative basis, WTI has been very strong, right? The WTI spreads have performed, like you said, Vincent, spreads don't lie. In WTI, definitely something going on in the US. Declining inventories, people taking advantage of the declining inventories. WTI spreads performing very well on the prompts. 150 is undeniably a strong level. So I think a lot of people are buying into the WTI versus Brent. The export situation, you're desperate to say something, James.
No, I was going to say something that strikes me with this is the CTAs.
Yeah.
The majority of CTAs are basically trend following.
Yeah.
And that's telling you exactly what's happening in the price action. And it's the money managed that's long, it becomes a pain trade. So they start to get forced to unwind positions.
Yeah, no, yeah, exactly. I mean, this has been the case for a while that the flip-flopping of managed money section is driving these kind of incremental moves, but they're not that meaningful. So I think we've said before, if we want this kind of, pun intended, shit to turn around, it's going to have to come more from producer merchant, refiners, majors, trade houses kind of really turning around their more sizable positions and having a structural kind of view short. So, that could very well happen. It looks increasingly like it will, but I think just to explain the recent moves, I think that all makes sense.
Yeah, just like looking at just larger economic or just fundamental data that could perhaps have explained just this de-risking. It's interesting that like the market has basically ignored what happened in the US over the weekend, Biden stepping down and his endorsement of Kamala Harris. But demand concerns from China continue to linger, and it is a fragile state for demand that's coming out of that economy. But it'll be interesting to see what happens there. I think James is going to talk about this too, with the BBOC cutting major short and long-term interest rates. So it'll be interesting to see if we see more just manufacturing come out, just anything come out with manufacturing, and whether that affects demand or just sentiment. But for now, Morgan Stanley analysts said that oil will likely be in a surplus in Cal 25, bringing prices to their estimate of the mid to high $70.
I mean, that's relatively significant for me because, again, people are looking for these analysts to shape, consensus views. And for a long time, maybe 5 years, we've had basically all analysts bullish, but Citigroup bearish. And that's been the state of affairs. So for Morgan Stanley, like a new bank to be bearish is actually, that's new. So I think sometimes, at the end of the day, what they're all doing the same thing. They're looking at the supply and demand modeling. They're putting in their assumptions, and it's all about those assumptions, which gives you their base case. And you have to do a lot of manipulation of the data to get you to a bullish view. It needs a lot of growth and economic demand. That's why OPEC have been very vocal about the growth of 2.5 million barrels a day, which coincides with their cuts. And people, I guess, who want to be bullish are trying to go along with that, but I think it's a very hard thing to do. And Morgan Stanley clearly have just gone, look, this is just not. When they say it will likely be in a surplus, to me that's as good as saying this is definitely going to be in a surplus. We can't get it to work. Like, we'd just be lying. Anyway, that's because it's just they're 99% of the time bullish, all these banks. So for them to be bearish, it just means how are they going to justify it to clients if you scrutinize the data? But on the flip side, as you said last week as well, Vincent, like the one thing that's still bullish, we can't deny, is the underlying what we call structure, right? Time spreads. And again, to repeat, time spreads are really important because they are actually reflecting a physical differential. There's a very strong link with the physical, much more so than the outright flat price. So when they are in the dollar per barrel range, which it is just about in Brent or just below, but definitely so in WTI, undeniably that is strong, right? And so strong that, something must be going on. Either it's very well propped up, kind of to the point where it actually is costing money to keep it that high, or the markets are that strong. And that is the debate the market will be having right now. But when you start to see these sell-offs like you had on Friday, you could also add to the fact that, people want to see buying throughout the day, and then opportune moments where you think the market kind of won't notice, you kind of put in a bit of selling flow and you start to use things as a liquidation event because you don't actually believe in this recent rally. That's very common, right? It's all about perception. You want to give the market a perception that it's got bullish momentum, and you'll see, you know, it's hard for us to understand, you know, given our trading size, we're very high frequency, very high volume, but not on an outright basis. We're not going to buy 20,000 lots of flat price, but there are quite a few firms who can do that. So in other words, you know, I remember seeing someone even quoting on the FT saying it was like, look, if there's like a bearish DOE, Department of Energy statistics out, and the market's starting to sell off, you know, what's buying a few thousand lots when you've got 100,000 lot position on? You buy a few thousand, it supports the price, maybe even causes like a temporary bullish impetus, and then people then interpret the data differently because they go, oh, the market's reacting bullishly to bearish stats, so it must be bullish. So you want to have this sense of like momentum in the market when the market is paying attention. And then when people go behind closed doors, you know, you can offload, and you want these opportunistic moments. But this time round, you're selling into settlement 7:30, and sometimes there's just not the liquidity there, even though it's usually quite a good time for liquidity, which does show you like actually when you need to liquidate some of the length, the market can't take it. It's another bearish sign for me. But anyway, just thought I'd mention that.
Yeah, something I would say with the Morgan Stanley call, it's a new downside call, but even so, to say for next year mid to high 70s is still a very narrow range to where we're in.
Yeah, because it's safe, right? If you come out and say 50 and it's not.
And also to say likely downside move next year, likely surplus. Again, it's safe and
well, you can still say you made a right call if the market goes down to 50. But you can't, if you say 50 and it doesn't get there, then
it's a bold call.
You just,
But if you look at the chart as well, the range this year is something like 92 and 70, but it's been converging, it's getting narrower and narrower and narrower. So we have recency bias. We tend to think in our heads we're stuck in that range. But if you look at longer term, if it breaks above 88, to have the chart a bit later, 88 and 70 to 88 and 70 are key levels, but a break either way, you'll likely see an aggressive move.
Recency bias quantitatively, I guess, is volatility in a way.
Yeah, absolutely. Yeah.
And I guess, Mita, you got notes here saying volatility has risen as well, right?
Yeah. Yes, so despite the removal of open interest, if you look at implied volatility, for both Brent and WTI, it has risen.
That's a significant thing, but yeah, go on.
Yeah, and very significantly as well if you look at past weeks.
Right.
And it's risen more so for put options than it has for calls. It's like a slightly like upward, like tilted smile right now.
Right.
And yeah, so that's really interesting to see at the moment.
It is, because we've been in such a low volatility environment for basically the whole year. For there to be an uptick and it to be towards the downside and all these things starting to build momentum, it just sounds always like we're talking a book. It's just because it just is lining up that way, isn't it? Everything we're fucking hearing is like.
Did the vol pick up with the Trump
so it was
assassination attempt? Because that's obviously when now it's almost a done deal. The market's suddenly saying he's getting in, and the market's looking at all these Trump trades.
It was until the 22nd of July.
Yeah, I don't think there was a reaction. If anything, it was quite calm markets. Yeah.
Yeah, I can't really pin it down to just the Trump thing. I'm not sure about that.
You've seen it in equities in the last week. Suddenly, that's slightly different. But AI stocks getting hit, and you've seen vol suddenly pick up in that market as well.
I think it could have something to do with that, but I think the WIX has also risen, for example.
Yeah.
So I think just with oil also being a risk asset, maybe something just filtered into like this market as well. I can't really pin it down to one specific event, but yeah, I think like just overall macroeconomic sentiment and just how bearish, like just a bearish turn as well. I think all of that could have happened.
I think we absolutely need to talk quite a bit on macro today again, but I think just to test the underlying market, given what's going on. So again, defining the market state, peak summer, middle of summer, trading months at least, in July, trading July, August, Sep. This is when were hoping as a market consensus that refining margins would improve, gasoline would improve. It's not, we know that. But the one thing that is performing is crude, right? So crude being performing so well, at least in the underlying structure, is like by definition bullish. However, it's going to get tested now, right? So quotation marks, high prices in crude, strong backwardation, in other words, strong physical premiums. On the upside with WTI, of course, it can perform like it has done in all like really bullish markets, but because it's landlocked and because it's about the actual storage in Cushing as the hub in Oklahoma, the people who own it have always had this like disproportionate control ultimately in extreme environments. So when the backwardation is so strong, it's basically a great opportunity. If the market fundamentals aren't genuinely there, then the guys who own the storage can basically say, great, well, in order for you to buy the oil off me, you're going to need to actually buy storage in Cushing to do it. So if I flood the market all at once with all the storage I have available, because the backwardation's so high, I'm going to get $1.50. I'm going to get paid $1.50 to sell it into the open market and buy it back again next month. And I know I have the majority of the storage. So how's the market going to buy enough to absorb? The only way it can is if it can take it from trucks, take it from other means, essentially railroads and all that. And that's only if the market demand is there. So if the market isn't at a strongly backwardated level, it's really vulnerable to an aggressive sell-off now. And in backwardated markets like this, where the market fundamentals aren't that good, best trade on the board is short TI spreads in the prompt, and it's like a carry trade. You just basically hold the short spread into expiry and you roll that down always, because if you just think about it, right, even if you're not doing anything, you haven't got any particular agenda, you're just looking at it with storage going, why would I hold this in a tank? It's so expensive relative to next month. I'm just going to sell it out. And it's just into expiry. It just makes complete sense for it to evaporate unless the demand's there. So I would say right now, if our consensus view, like here at least, or internally, is look, we think the market needs to weaken, I would say best trade on the board is TI spreads then into expiry. If not, buying kind of puts because of the low volatility like you were saying before. But I think that's the one to look at right now. So if it does perform into expiry the next month or two, WTI, and the way to know that is obviously the actual price on expiry. But then after that, you hear the WTI cash spread trading, and that's the physical crude spread, and that's the refiners saying, no, I actually need that oil. Looking out for that. And if that stays strong, then yeah, you actually have a market. It will give you a good signal. But I think we kind of believe the demand's not there. So that's that. And just to stay on the underlying market before we move to macro, Vincent, so what's going on? How do we summarize the refinery margin situation?
So to summarize, overall refinery margins are not bad, not good. There is no contradiction between the strength in the strength in crude markets, the backwardation versus weakness in the product cracks, and namely gas oil, distillates and gasoline. That is because, of course, refiners are taking advantage of these margins. They are buying up the crude. However, they've also been producing quite a lot. The market's been adequately supplied. And according to IRR data recently, the unplanned outages for refineries are unusually low for this time of the year. So compared to the same time period over the past decade, meaning that they're producing more than what is expected, and combine this with weaker demand despite being in peak driving season, as well as not too many extreme weather events. That's why we're seeing downwards pressure on the crack spreads. And combine this with the psychological factors. A lot of players were quite excited early on this year. Now they've been liquidating their positions, stopping out. For example, in gasoline, we could attribute the EBOB crack sell-off last week to weakness in Europe. The demand outlet to the New York harbor isn't there anymore. And actually 2 months ago, when gasoline first sold off, many players would have added length as a buy the dip trade, but that also didn't work out, so leading to potentially more excess of their long positions. So a lot of these combined have led to bearishness in the product cracks.
Just generally speaking, yeah?
Yep.
Okay, but isolating, say, the gas oil?
Within the gas oil, it's it's been on a downtrend since the start of July. Cracks below $19, spreads at the front, very stable contango. It's kind of we think it's in a no man's land, because at contango levels, not much more downside in terms of risk reward, but also no bullish catalyst to indicate a strong reversal. So unless there's unplanned refinery outages or severe weather events, geopolitical risk, disrupting production and causing, exerting prices to the upside, there really isn't. We don't think there's much room for prices to go in either direction.
Well, I would only caveat that as devil's advocate, making the point that refinery margins are still quite healthy in the prompt in a lot of scenarios. I know some they're not, especially on a net back basis, but look generically at our benchmark refinery margins, $6 in Europe. Okay, well, if they're able to run and make profit, they will be. And if the market can't take it because it's in contango, gasoil is like one of the biggest yielded products. So if you're constantly producing, even though the underlying fundamentals aren't there, the refiners don't care. Like if I can lock this in on paper, or if the refinery margin is there, I'm going to produce it. And if you can't take it, that's your problem. So you say there's no downside, but if you're in contango and the margins are strong, that means more supply is going to come online when the market can't take it. So that would be my caveat to that. I would say, if anything, the contango is going to be, or the crack level should be under a lot of pressure on that basis. You see what I mean?
Yeah, potentially more on the cracks. If it's contango, then it might incentivize some like
yeah, so
carry
you could, yeah, exactly. You could carry trade, but the outright crack is going to be sold into on a physical basis. They're going to produce that because it's still a strong level. And again, I've said this a few times, but people need to remember, like, it's historically actually at a high level, this crack. It's just only in the recent few years it's not high because we're used to like $30 to $40. It's usually around 12, 10 to 15, and it's 18.50. So we've got a long way to go on a crack basis, basically. Yeah.
a lot more downsides. Interestingly, though, there's been the strength in naphtha has been maintained. It is the market that's most quite sensitive to geopolitical concerns. You know, you have the Houthi attacks, the Red Sea shipping disruptions, because a lot of the exports are coming out of the Middle East, and there's been more strength in petrochemicals these days. So both Europe and Asia are competing for these cargoes, and as well as like the recent tightness in WTI. Midland cargoes are famously more naphthenic. So
CPC as well. So CPC, when the new pipeline was built, more capacity. Basically, the CPC diffs went from like, I think from memory, around +2 normally to dated Brent to like -2 was like a normal level, and in weak markets down to -4, and strong markets like kind of up to flat. They got to their highest level in 6 years, and again, it's super naphthenic, the CPC grade, which would make sense. So that's now starting to dip as well. So I wonder if, as you say, the WTI move, as well as the stocks and all that, but on a yielding basis, naphtha generating crudes have done very well, like CPC and WTI, but it's almost like the damage is done now into the market because the diffs got so elevated, the backwardation spreads got so elevated. In order for that to sustain, you know, things need to be macro strong, whereas this is like a localized thing. So the way to have captured this move, like retrospectively, obviously, is relative value trades like WTI Brent, like CPC you can actually trade. You can trade that versus dated. But clearly it hasn't been a macro bullish event. Otherwise the whole complex, you know, flat price will be rallying, everything will be rallying, margins will be rallying. It's obviously a localized naphtha yielding thing. So it's a good spot there. Is that everything on margins?
That's the thing about margins. I think Meta was doing some research recently on, we're talking about the butane strength as well, right? I think that's worth a mention too.
Yeah, so the strength in naphtha, especially in Europe, has also helped propped up NWE propane alongside bids in the physical. So European propane is really strong, and something that's been really interesting is that butane has been really strong everywhere internationally and in the US. A lot of that comes from petchem demand right now because butadiene margins, especially in Northeast Asia, are really high, and they continue to be high, and that's been helping elevate US butane. So the C4, C3 spread, that is the butane versus propane spread in the US, has been really strong still. And in the Middle East, there was recently a tender to buy more CP propane, that is more Middle Eastern propane, and that then help elevate butane prices in the Middle East. So even in Asia, there has been a lot of butane versus propane buying in just the Far East and the Middle East. So butane prices just everywhere have been really strong.
No, again, it's a good spot because, again, propane as well, like the CPC, they're just very liquid paper contracts. But this is why it's worth having a presence in these contracts, because when they are traded, it means something's going on fundamentally, because there's not enough financial volumes and flows for there to be many speculators, if any, right? People generally use that as as a physical hedging tool. Like, they're not using it to be like, oh, I'm just bullish generically, let's get long. They're trading such a niche contract because they want the accuracy in the hedge. But then it in turn gives you information, because if they really want to hedge that specifically, it means it is specifically about butane, not the LPG complex. So for that to be going on, I would say the LPG market or NGL market has generally missed that this year. And I've noticed it myself. Butane pretty much all year has defied expectations. It's meant to have like a big sell-off kind of post the winter spec gasoline. And I think we did have a correction, but Very strong kind of physical pricing in a couple months this year.
There was a major rally in beauty in the middle of June, which is just uncharacteristic for the contract.
Yeah, no, exactly. So no, look, it's a good spot, and it's avoids you. I think for me, I like these kind of indications, because you can't say, oh, it's a financial flow thing, someone's stopping out. It can't be, because it's so localized and it matches up with the fundamentals, matches up to the cracking complex. And I think it's something that, we need to look at more in the future, because we generically will say cracking demand, bullish naphtha, because it's the biggest cut of the barrel that's used for cracking. But then if propane versus naphtha gets too weak, then we're saying, well, people are going to switch to using propane to cracking. That's generically how you look at it. But there's also butane, there's also ethane, but ethane is even more niche. So anyway, a fundamental shift has happened this year with butane is basically the point. But I wonder what that really means. Does that mean that could be, if it's going to be tight all year round and it's a structural deficiency, does that mean by the time we get back to winter spec gasoline, it could actually be bullish?
That is really interesting, because I was reading a report about winter spec gasoline, and how blenders are going to start making these decisions on whether butane is still economic it's still economic for them to use butane in their blending pool. And currently it is, but it'll be really interesting to see whether that sentiment also makes butane rally further, like whether we've got gasoline blenders and petrochemical players both working on strengthening butane further. And then what does that mean for butane in the winter?
No, good stuff. Okay, macro demand then, which is a good way to segue from that, really, because we're talking about macro demand shifts in Asia there. China central bank actions recently been pretty significant, but not necessarily, because it's quite niche, people aren't going on about it that much in the news, but it's pretty significant, right, the recent moves by China?
Yeah, firstly, it was unexpected by the market. So when central banks move and it's not expected, then clearly they're seeing something or they have concerns. And it takes time for monetary policy to filter into the markets. Yeah, I keep saying in the US it's seen as a 6 to 9 month lag, but clearly the central bank's wanting to act. And the US data in the US last week there wasn't any key data, but it's a bit mixed. Industrial production, retail sales, and Philadelphia manufacturing came in just above expectations. But for me, employment side is getting worse. Jobless claims and continuing claims both rising, going up. But I think something really that's gained more traction last week is the Trump trade. The market's now perceived he's almost a done deal that he's going to get in. If he does, obviously he's going to impose the tariffs. That's going to have an impact of up to 2.5% on Chinese GDP. So that's going to hurt China as well. Now, of course, he says 60% tariffs potentially on China and 10% on other countries. Now, that's his first bargaining chip. So it's probably won't be that extreme, but that's going to hit global manufacturing. And then as well, the US manufacturing will get hit as well, GDP, because they're going to be subsidizing unproductive industries.
Yeah, so it's gaining momentum that we've essentially reversed all the inflationary concerns of the last, let's say, 21 to 23, really. So basically, it's now the reverse problem. We're probably worried about deflation to some degree.
That's going to be possibly an issue in Europe towards the end of the year and next year.
Yeah, but
actually,
then
a poll with hedge funds as well. What's their biggest concerns? Moved away from inflation. Now their biggest concern is geopolitical risks.
Yeah. But again, talking about the Trump trade, I mean, something we were debating last night on our trader chat, actually, right? I think it's worth discussing. I mean, generally speaking, when I read about Trump in the media, trying to gauge kind of how people are viewing it, what could be the ramifications, I would say generally the consensus is he's stupid, right? He's not clever. He's doing something that will never work. I think you should never underestimate like people in these situations. A lot of advisors, like he's had a 4-year term. When he says he's got a plan, I think he's definitely someone to believe he will put his plan into action. I think that's a fair thing to say. And he's been pretty, I think Politico were the first people to report that their new ambition when he's in power this time is to target the dollar, to weaken the dollar. I think they see that as a way out of the trade deficit firstly, but then filtering into the debt spiral, right? That can actually help. And we're going back to like Plaza Accord type situation in 1987, where I think it was basically the same scenario. The dollar had rallied so much. They're like, this is getting ridiculous. Everyone's getting rich off us. And I think, was it UK, Germany, France, Japan all got together and sold the USD, and then the dollar then depreciated. So if they're going to go for that again, clearly he's looking back at how do you get out of this sticky situation that everyone can see we're in? Well, lowering interest rates, printing money, I think that's what you were saying, right? That's the move. What you're essentially doing is causing inflation again, right? Yep. But at the same time, you're lowering USD, that helps with their debt. So then what happens with inflation? Well, gold's rallying and things like that, but oil is probably the main one still. And at least from Trump's view, how he tweets, how he talks about the market, he seems to really focus on oil when he talks about inflation. So he knows, right, when they're in a great position from an oil production perspective. Drill, baby, drill, he's already said that. So it makes sense if you think you're going to cause inflation again because of your macroeconomic policies, then you should overproduce oil to keep a lid on it if there's inflationary impacts, to then not suffer from inflation. So you export your inflation because you're getting everyone to buy your oil, cheap dollars, and you're producing a hell of a lot whilst you're creating inflation by lower dollars. So it doesn't seem dumb to me at all. If anything, it's like, why can't this work? I think your reservations were, as a reserve currency, it's just going to be too difficult, I think, to do.
Yeah, if you look at the US dollar isn't that strong. If you look at it now, historically, the dollar index, it's not incredibly strong. I understand your point of view. I see him more as a protectionist of the United States. Yeah, tariffs will help support the tax cuts that he wants, but he wants to stimulate growth. The curve will steepen. That's a trade that's already being put on as well, because the curve's been inverted for nearly 2 years.
No, but I think we're talking the same thing. Right, the tariffs will cause a weakening of the dollar, right? People reacting to it will tariff them as well. Surely, like that's bad for trade, bearish the dollar, right? If the US isn't being used as much in trade, is that not just bearish the dollar?
I don't see that has that big an impact as much. I tend to see the currency, the impact is clearly, firstly, interest rates. And it's very hard for a central bank to, before he's tried to put pressure on the central bank.
Okay, so essentially you're saying if he had his way, this is possible, but it's independent. The Fed is independent. They can lower and increase rates when they want, and they won't.
And you can try and talk down the currency, but we had this after the financial crisis, and it became a tit for tat.
Yeah.
And it ended off sort of a stalemate, and the central banks decided they wouldn't talk about currencies.
Well, then it is back to the idea of, can they achieve the Plaza Accord again? Because, that was a coordinated event I didn't know about until I read about it recently. And you say, okay, if you were going to try and do that again, how would you convince other ones to do it? It's a very different economy to what it was in the 1980s. And, China are the big economy now, and they weren't before, right? It was Japan. And China aren't going to help the US. But I'm thinking, if you then broaden it out, if you're talking about the Trump trade, well, he wants to end the war, right? And ultimately, ending the war is a bargaining tool, as in what's the ramifications of that, the NATO situation. It's all part of the same game. And ultimately, he can say, can't he, if you're not going to help me weaken the currency, then I'm not going to help you export. That's just how it's going to go, right? He's going to...
But also, ending the Russia-Ukraine war, they can start to put less money into defence. That's a huge cost for them. And also
into
defence.
Yeah.
The US is spending so much on defence.
They'll never do that, surely.
Well, they can force this. What they're clearly doing is they're forcing other NATO members to sort of step up their defence spending.
Yeah, true.
But also, Russian oil then can come back to the market as well.
Yeah, I would say that's the one I'm like kind of, I think generally internally, we don't see that as any issue because Russia oil has been flowing. The only thing that's happened is restructuring of flows. There is no new oil to come out. It's only if anything, Russia have been overproducing, they've actually kind of been slapped on the wrist by OPEC. So actually, if anything, they're cutting back on supply. They got no room themselves to increase anymore. So I don't see that as a factor. However, back to the diesel point, if there is exports of diesel coming back in from Russia into the Med, into Europe, that was a big structural flow that had to be replaced by India. So if that comes back, to be fair, that's bearish that cracks Europe 100%. So that's probably the only real trade we can see. But I don't know.
I tend to think if there's a dollar play, it's going to be the plays you see beforehand of right now, the economies are slowing, central banks will be cutting rates. And what would happen first when Donald Trump comes in is he'll be trying to push to produce more oil.
But because I think he sees that as the counter to inflation-inducing economic growth, lowering interest rates, all that. He knows that's inflationary. So the counter is to produce more oil and the US benefits. They double benefit. I think it's pretty likely. I know it's going to be interesting, but again, at least we're thinking like a bit further forward. Like we looked at, was it PIMCO's research yesterday, that, and you read around and there's just these consensus generic, I think Trump is not the type of person to not put through structural changes and not be serious about putting a plan into action. So why would you just think it's all going to be rosy? Like volatility is for sure.
Volatility for
Yeah,
yep.
Being so, basically that's the one thing we can say.
And
Volatility
Europe's
being as
got to
low
be very
as-
nervous.
Yeah.
And also, as I say, China's got to be nervous as well.
But the temptation is to say currencies are related to economic growth, right? So, we've essentially been, you're bearish sterling, you're bearish euro, bearish sterling because of Brexit and economic worries. You're bearish Germany, you sell the euro, you sell the sterling. But actually, it's come so far, it's not really the trade going forward because of these macro or these fiscal and monetary policies, right? Ultimately, if anything, it's the opposite. You actually want to be long the sterling, euro, yen versus the dollar if Trump comes in my opinion, because if the inflation gets exported, Europe are going to have to eat that, and Japan are, and ultimately they're going to have to fight it with at least keeping rates high because their economy isn't it's just not something they can fight.
But then they're going to have stagflation. So then,
that's what happened to Japan, right? They lost.
But then
decade.
the currency gets hit. It's not a straight interest rate play. The interest rates are not going up because the economy is strong. Interest rates are going up because of stagflation.
Yeah.
And then you look at issues like we've seen it in South America and Turkey and what happens to currencies in that situation.
Yeah. No, it's a whole new landscape.
It's going to be so interesting.
Yeah. Okay, great.
Volatility is the winner.
Yeah. And on that note, bringing it back to Brent, we're going to start to talk more and more about technical levels, right? Well, ultimately, when you're on a trend, the technical levels start to be very important. So we've already kind of engaged, as Mita said, the CTAs we think are... he does in the background. I think we keep that in. But the CTAs switching from... Basically, I think... I have to go back and double check this, but I'm pretty sure that they've been long or flat or long all year. And just suddenly, remember you were saying, but we haven't even seen them short yet. And now they are. The CTAs are now starting to be short and recycling short, taking basically on little resurgences from the low 80s back to 85, that kind of homeostasis level, the CTAs are kind of getting short, flat. But it's recycling short, if you know what I mean. And we're yet to see a big kind of trending short kind of momentum play then. And if we hit these technical stop levels, that's going to add to the bearish momentum.
Absolutely. And what I love about CTAs, they're trading the price action.
Yeah.
We can talk all day long about what we think, but it's purely the price action that's the arbiter of the P&L at the end of the day.
Well, and if we set a new trend, which the oil market's desperate for, right? There's nothing worse than no trend in an oil market as a trader. So the market wants a trend. So it's looking more and more likely, isn't it, ultimately? And the key technical levels, I guess is a bit spoiler alert, right? Because we did the poll last week. Yeah, so we had, where do you think the key stop loss level in Brent crude futures is? 82.80, which is the 200-day moving average. A trend line support at 79-ish. The low in June, 77. And the low since January 20 is 72. Now, most people, 39% said the 200-day moving average. And why do you think most people said that? Because ultimately that is a CTA thing, right?
No, I disagree with this actually.
No,
because
I know you do, but I'm saying why do you? I'm just trying to build it up.
Yeah.
So why do you think people?
I tell you why, because if you look at US equities, people love the 200-day moving average. If you watch financial TV, you'll hear it mentioned every day. And it's a really good technical level if you're trading an index in the US, and it's basically a stop. You're long above, you square up when it goes through, because if the index goes up over time, then you make money. What it means is when there's a big drawdown, you're out the market.
But we dip below 82 very briefly.
But why it doesn't work so much with commodities is like FX. Commodities over time generally go sideways. So you can't use you're not following an upward trend. So I've never really heard of a 200-day moving average being used in commodities or FX.
Okay. So what is the right answer? James,
in my view, and we can bring the chart in, but it's 72 to 70. There's multiple lows going back almost 2 years. Mm-hmm. The market keeps bouncing off that level.
Yeah.
So that's where the support comes in. And there's a downward sloping trend line, the resistance comes in just above the last swing high at 88. So I'm going to say sort of 70 and 88 are the levels, but if it breaks, if we have these longs in the market, where would you have your stop loss? It would be just below the key support, which is where you have the long-term trend support. So
but I also
just
think
below
even
70.
though it's a technical level, like a technical level, it's also psychological, right? So, and that's the great thing about these things. Some of the people that won't have a stop in for 50,000 lots, because that's manic, right? You would never do that. But you will say that is a psychologically shifting number for me. If it's starting to break ahead towards 70s, like I didn't think that was possible. I'm wrong here. I'm going to get out. And so it doesn't necessarily have to mean a stop that you will see literal price action immediately off the back of it, like an exchange stop. But it could be a psychological stop for a lot of big traders, right?
Yeah, typically as it heads down towards, if it goes down towards that level, low 70s, you'll see some buying come in, and it typically bounces first because people who want to be long say, well, it's a cheap option. I'll have my stop just below. But if it breaks below, those that are long, many will use it as a stop. The other point is that people who want to go short, that will be their entry level. So you'll see selling from both sides.
Understood.
And typically you get a break lower from that.
Okay. Key data this week, right? One to watch, US.
Quite quiet week. US Q2
I thought
GDP.
you said the earnings this week's massive.
It's the biggest week for earnings in the US.
Okay, yeah.
There's Q2 GDP on Thursday, I believe, and on Friday you've got inflation, the Fed's favourite measure, PCE, personal consumption expenditure.
It's a pretty big week.
Yeah, it's a pretty big week.
Okay, but from an oil perspective, Googling oil, is this you, Vincent? Like, what's the chat?
Yeah, sure thing. Chat is first one. Russia considers building oil refinery in Cuba. So the two countries have discussed the idea of building a refinery with the help of Russian companies, and biggest Russian state companies could be working here. This is also to fill a gap in for Cuba's in terms of their oil imports and energy security, because typically they're very much reliant on Venezuelan crude, but they've been receiving much less recently, and oil products account for 80% of the country's power generation. Less of that means more expensive energy prices domestically, and that's created some social tensions as well. So, of course, with the countries, the past history of the two countries, it seems like it is in their interest to be working together again to help out with the energy security and all of that. So it's not so surprising.
Yeah, but it's the tinges of Cold War, right? I mean, ultimately, this was the big thing, Cuba-Russia relations. So anything towards that, it might just be, why does it need to be in the news? Because a bit of rhetoric, heading towards, again, going back to the Trump situation, that kind of, the Ukraine war is back in the focus, right? Because we're thinking something's changing from the sentiment perspective. Actually, what was circulated last night with the traders as well was BBC actually talking to Zelensky about corruption, saying, it's a pretty serious problem, right? You've had to fire the Chief Justice, there's this. And obviously he's evasive, doesn't want to be, too negative about his own country, of course. But ultimately, Ukraine, a lot of people do understand it was voted like one of the most corrupt countries before the war. And, given how much money is received, it is likely that there is a lot of corruption going on. But why say it now? Because everyone knew this. It feels like a changing narrative, right? It's a good excuse to be like, well, there's a lot of corruption going on, so we can't really trust that our aid is getting there. And it paves the way to start saying, actually, maybe we should end this war. That's, I think, our interpretation of it. Of course, who the fuck knows? But ultimately, that's kind of, in terms of Googling oil, what's going on, I would say that has to be something, even though not directly linked, it's obviously going to have an impact on sentiment. Anything else on that?
It lends naturally to the next headline, which is Slovak PM Prime Minister blasts Ukraine's Lukoil sanctions as oil flow stops. Robert Fico told his Ukrainian counterpart on Saturday that Slovakia will not be a hostage to Ukraine-Russia relations after Kiev sanctions on Lukoil halted deliveries, in which it goes from through a pipeline via Ukrainian territory. For Slovakia, that means the Slovnaft will receive 40% less oil for processing than needed, which has implications for energy security as well. So again, it's the debate between energy security versus geopolitics.
Well, it just means that they have to, being inland, they're going to have to pay for it to get there some other way. Trucking, there's no pipeline like right there, right? That's been circumnavigated. Well, they're going to have to circumnavigate it, and that's just an expense. And ultimately, you're paying for that. So the more you have to pay for it for a sustained period of time, you're looking at the market price, you're looking at what you're going to have to pay for your oil because of the sanctions, and it's going to put pressure on unless you believe in it wholeheartedly. So yeah, that's yet another, I guess, instance that people are potentially getting a bit of fatigue on this situation. Is that fair to say, James? Yeah. Okay. Anything else?
Yeah, we got one more from the BBC. Why Nigerians are praying for success of a new oil refinery. So a prayer was held a few months ago in Kano, a very religious city in northern Nigeria. It was organized to pray for the success of a huge new Nigerian oil refinery, Dangote. As you guys would know, the next month is due to start producing petrol for the first time. But of course, it's symbolically very meaningful because the people are hopeful that the new refinery will lead to a large decrease in domestic oil prices. However, although there's a lot of hope for it, the counter argument would be that the country doesn't want to be relying on the refinery too much. What if there's a refinery outage, or as well as some particular environmental concerns, emissions, as well. If there was like mishandling of equipment leading to crude oil spills, that could be a problem as well. But there's also a lot of hope too, because previously Nigeria has had to import a lot of gasoline, but now
it's the same point as the Slovakia here, right? You mean it's the import costs on top of the benchmark price, so they don't have to pay that anymore, right? You got the basis. I think there'll be a lot of trade. Ultimately they're going to use a lot of the gasoline, but a bit like an airline, Delta Airlines bought a refinery in the US. They wanted it for the jet fuel, and they had to then make a trade. I think it was with Vitol to be like, you take all the other products because we just want the jet fuel. It's a similar situation here, right? A refinery is huge. If they're not going to use all the products, then they're going to become a major trader. And I think a good similarity there, I guess, is in India, right? Ultimately, the Jamnagar refinery, it satisfies so much of its own domestic demand with India oil and all that. It's actually now like they're a proper trader, right? They sell those into Europe. So I think it's a good thing, ultimately taking ownership of their trade. It's going to be good for their balance. I don't know why it wouldn't be a good thing, but I see the point about if something happens with it, then but that's like it's a huge refinery. If it all goes down at once, it would have to be like a nuclear strike or something, right? Ultimately.
Yeah, definitely. Or just up oil getting there.
What do you reckon?
No, don't think so.
Okay.
Wouldn't bet on it.
Yeah, it's been talked about so much in the media for so long. Like, it looks to be success, certainly more successful than HS2. So ultimately, they've pulled out the bag. So it's going to happen. So good for them.
It's interesting they're praying for success. I used to pray for success in my trade. Sometimes it worked, sometimes it didn't.
It's not a good strategy.
I hope they have more luck.
Yeah, bargaining. That's the bargaining. That's the second stage of loss. So yeah. Okay, trade idea for the week.
Yeah, sure. Trade idea, we can suggest going short in the Brent Dubai complex. So because Brent Dubai has similar to WTI, the spread has really surged in recent weeks. The outright's gone from like flat to 60 cents per barrel. It's been relentlessly rising in the month of July, and we're expecting potentially mean reversion coming in, because at what level do you encounter more resistance where Middle Eastern crude rates become cheaper? And on our COT dashboards, we've been seeing more sell-side flows coming in these days down the curve. A lot of trade houses want to take advantage of the strengthened spreads to sell into it, and we think that the momentum has been quite strong recently, but it's always encounters a turning point in which the natural course of the Brent Dubai is to go up until a certain level and to grind down gradually. So we think we might be reaching an inflection point coming soon.
I think inflection point's key because again, with the refinery margins and gas oil market, if the gas oil market continues to weaken, it's going to put that pressure on the European margins, where, given how strong crude is, cutting runs, and ultimately as summer comes to an end and the demand didn't really follow through in contango and gas oil, then Brent Dubai should weaken because less people want local grades because the local refiners aren't running as much. So I think on that basis, it's quite an interesting trade as well. But I also just want to reiterate the WTI trade as well to add to the trade ideas. I think that's probably quite a good one. And yeah, I think we'll leave it there. It's very interesting stuff going on. Again, audience, please be sure to check out Jorge Mentepeque's new podcast, The Officials. And please like and subscribe, it really helps. Really appreciate your support as always. And there are a few changes that are going to come up soon, and you'll have more information on that soon. But I hope you're enjoying the channel, especially on YouTube. We're putting a lot of effort behind it, and there'll be a lot more to come. Thanks very much, and see you soon. I can't believe USO has options. That's sick.